The time has come for the Cobra to rise up and reveal himself.
Let's take a look at monetary policy, tool number 2, the discount rate. And the goal of the discount rate is to be the banker's bank. Where can the banks go when they need emergency money, when they need emergency liquidity to help get through a crisis? And the member banks can go to the Federal Reserve, and the discount rate is the interest rate at which the member banks can borrow money from the Federal Reserve. So this is the interest rate that the Federal Reserve charges its member banks if they want to borrow money. And so for discount rate, think about like if you have like a Kohl's, if you're a member of Kohl's or Macy's or a department store, when you're a member of these stores, you get a member discount. So the banks that are a part of the Federal Reserve get a member discount. They get a better interest rate going to the Federal Reserve than they would potentially going to someone else. So because they are members of the Federal Reserve, they get the interest rate, they get a special interest rate to borrow against for being those members. Do not confuse, and the big trick is not to confuse the discount rate with the federal funds rate, because the federal funds rate sounds like it should be this, but it's not. The federal funds rate is the rate at which banks borrow from each other, and the discount rate is the member discount, that the rate that the member banks of the Federal Reserve borrow against, that the Federal Reserve charges its member banks if they want to borrow money. So let's take a look at a contraction, how the Federal Reserve, and this policy is used in the middle. It's not the least used, not the most used, it's the one used in the middle. And again, during the Great Depression, the Federal Reserve does the opposite of what it's supposed to do, to try to stem the stock market crash and create stability, and just from plain panic, the Federal Reserve, at a time when it's supposed to decrease the discount rate and give its member banks greater liquidity and greater flexibility and greater cash on hand, does the opposite and increases the discount rate. And the member banks start going under because they don't have access to loans and can't borrow against. So it is a bizarre situation where the Federal Reserve really, for the most part, besides the Great Depression, does most things correctly through America and through its time in American history. But Great Depression, it's the biggest, the time when it really needs to be at its best, totally fails. So let's take a look at the two monetary types of policy. So a contractionary monetary policy would be if the Federal Reserve increases the discount rate. This means that it is now harder for banks to get, it's harder for banks to borrow from the Fed. It costs more for them to borrow from the Fed. This would decrease the money supply because this would make money less available to the banking system. And as the money supply decreases, banks, to tell people that they have less money, and so one, to tell people they have less money that they could borrow, and two, to make more with less, would raise the nominal interest rate. This would have the dual effect of increasing the federal funds rate, the rate at which banks lend to each other, and also increasing the real interest rate, the rate at which businesses borrow against, that businesses are most concerned about borrowing against when they do investment spending. And this would decrease borrowing, decrease investment spending, and decrease aggregate demand. Inversely, decreasing the discount rate would be an expansionary monetary policy. Decreasing the discount rate would give banks greater access to money from the Federal Reserve, which would then increase the money supply. As the money supply increases, as banks have more money, in order to send a signal to everybody that banks have more money now because they're able to borrow at their member discount from the Fed, they would decrease the nominal interest rate. Decreasing the nominal interest rate tells people that, hey, we have money you could borrow, and since they have the extra money to entice people to borrow that money, they can now, and the banks are still going to profit, now they could lower the interest rate and more people will borrow from them. That the interest rate, remember, the interest rate to banks is like price to business. It's how banks profit. So if banks have more money available, they can afford to lower the interest rate so that people can come to the bank and businesses can come to the bank and borrow that money. The lower nominal interest rate will decrease the federal funds rate, the rate at which banks lend to each other, and also decrease the real interest rate. So now you have lots of extra money and you have lots of available more money in the banking system at lower interest rates. This will increase borrowing, increase investment spending, and increase aggregate demand. So this is how tool number 2, the discount rate, the Federal Reserve being the banker's bank, either with a contractionary monetary policy or expansionary monetary policy, will affect the banking system and thus affect the overall economy. Now let's take a look at our third but most popular tool, the open market operation.